what happened in the 80s is the government came in and said, oh, hey, you millionaires, you're just hiding money from taxes and avoiding taxes and putting all this money into life insurance because you used to be able to do that. You could just put a one-time dump in of money in and never pay tax on the growth. Well, good old government comes in and they get their fingers in the mix and they create what's called the modified endowment contract. If you put too much money towards the paid up additions rider and we get cash in there too quickly, it's all going to grow taxable. So what we do is we have to start more policies. So if you borrow money and you're going to pay back an extra $1,000, that $1,000 is not going to go in as a loan repayment. If you've borrowed $5,000, you can only pay back $5,000. You can't pay back $6,000 as a loan repayment because remember, they only charge 5% interest, not 20%. So the extra interest then, if you wrote them a check, they would say, oh, thank you, Mr. Customer, for writing us a check, but your policy is full. Your loan is paid back. So now instead of applying that $1,000 to the loan, we'll apply that to the premium. Oh, but I see here that you've paid the full amount. And if we put this extra $1,000 in, it may actually MEC the policy, and then it's going to cause the policy to grow taxable. Are you okay if we just send you the check back? You get the check back, and now what do we do with it? Mary Jo, Nelson showed that we can put it in the policy. Yes. Do we want to start another policy for $1,000 a year? Probably not. That's a pretty low premium payment, and you got to be pretty young in order for that to work. So a lot of times what we do is we just put that money in savings, and then when we start the next policy, we use it as a first year where we can put extra money in, and we get that overfunded so that we've got more money earning us some interest and dividends. Now, what happens if I'm not, it's going to take 25 years before I start a new policy? If you've got this $1,000 in your savings account, use that like you would your policy. Take it from savings and put it back plus interest. Treat that savings account as if it was a bank. The other thing that some agents do, and I'm happy to do it as well, is to say, all right, we've got a $10,000 premium, but we're going to be honest bankers and we're always going to pay extra interest at 20%. So we're going to build the policy to hold $11,000. Then when I pay that $1,000 of interest, I have room for it. That's all fine and dandy until your interest is more than $1,000. Because as we borrow money, every year we have the ability to borrow more money. So now we're borrowing more money and the interest isn't $1,000 on what we borrowed, it's $1,500. Well, where do we put that extra $500? We didn't build the policy for that. So where do we put it? Oh, we got to start another policy. So it's going to go into savings. So either way, eventually it ends up to go to a savings account if we're going to be honest before we can get it in the policy. So as much as we would love to build that policy correctly from day one, that doesn't necessarily mean that that's what's going to happen.